So friends, welcome to the paper analysis for CA Final SFM May 22 exams. One thing that I want to highlight to you before we move forward, if you are writing exams in May 22, please don't listen to my video. Okay, please come back and listen to this after finishing the exams. Okay, we are releasing, even though I know that we are releasing the video during exams, please don't listen or watch to the video during the exams. Come back and then watch the video after you finish the exams on May 29. Okay, till then, please do not watch. Okay, simple reason is a lot of people tend to get unnecessarily worked up by listening to my analysis or my answers or my suggestions and all of that. So unnecessarily don't spoil your mind. If you're writing exams, come back and watch this later. If you're writing in November 22 or if you're writing anytime after November 22, please watch the video. Please watch the video because there are a lot of important points that we're going to discuss in this video. Okay?
To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Hello friends, I hope you have written your SFM exams very well. So this session is for May 22 SFM paper, and believe me friends, this paper is super easy. This is a phenomenally easy paper if you ask me, and in fact I'll show you as we move forward. I have solved every single question in the class. So obviously the numbers would be different, but the question is ditto, except for the numbers, everything else is same. The kind of, the question, the kind of, sub-questions, the kind of, points that are asked, everything is same. If you had gone through our classes fully, especially for all the practical problems, believe me, you would have aced the exam. And I think it is very, very much possible to ace this particular paper. And there are no surprises in this paper, honestly. In fact, if you ask me, there are only positive surprises. They have not asked complicated questions in chapters like, derivatives, or they have not asked questions from your bond valuation and all of that. They have kept it simple. Right, and they have taken everything from study material. So I will take you through this. Okay, now you see what is this first question. Mr. Daksh is planning to import multi-purpose machinery, so on and so forth, for cost of $15,000, and he can avail loans at 19%. And this is a forex question. Okay, spot rate is something, 180-day forward rate is something. There is an offer from an Indian bank based out of US for an LC. Right, irrevocable LC. If you remember, we discussed a problem like this, exactly like this. Okay, and in this, the only if at all there is any complication where you can get confused is this line where it said 19% interest per annum with quarterly rest. Right, so when you're doing quarterly rest, you have to, this 19% divided by 4. So that is the only complication. If at all anything that arises, you may make a mistake. That is the only place where you can make a mistake. Right, other than that, you can directly compute. And one more thing, note, LC charges are paid upfront. LC commission is paid upfront on that day's spot rate. So $15,000 into 75 rupees into 2% into 180 divided by 365, that is the LC commission that you will pay. Right. So this is a very simple problem. As I said, we have solved this model earlier. There is absolutely no issue what you will face if you have actually attended our classes. Now justify why offer from foreign bank should be accepted, and then based on the condition, if it is not interested to take the currency risk and wishes to hedge with an additional expenses of 30,000, what is your advice? So basically what they are saying is, if they are not interested in taking currency fluctuation and they want to hedges for again 180 days, and with that 180 days hedge, the additional cost is 30,000. What are you supposed to do? Right. So then you basically have to compute the overall cost, overall cash outflow. If it was done based on spot, if you borrow money and pay it on spot versus if you do enter into a 180-day transaction, you have to compare the total outflow and then compute it. And here they have said 360 days in a year. So by 365 is also not there, directly by 360. Okay, now coming to the next question. You had purchased a 3-month call option on equity shares of Satya Limited for a premium of ₹30 each. Okay, and then market price of the share is 560 and exercise price is 590. Very good. Then expected share price is given. What are you required to compute? Expected share price at end of 3 months, value of call option at end of 3 months. In case of option is held to maturity, what is the value of the call option? Find out the right price of shares quoted at the stock exchange to get the value of call option computed above. So first 3 are already there in the question, and I told you also, if I am not wrong, I told you where is this question. This is question number 4 in our notes and question number 18 in the study material, right? Now in this, things where students can make a mistake is when you are pricing, computing the expected price, you directly multiply the expected price into probability for the share. Whereas in case of the option, you don't do that. What you do is you compute the value of the, in each expected price of share, you compute the value of the option, which is basically the expected price minus the strike price. and whatever is the value of the option, you multiply all the values of the option with their probability and arrive at the probability weighted option value. Point number 4, what they're asking is, find out the price of the shares quoted on stock exchange to get the value of the call option as computed in option 3. It is nothing but whatever is the strike price, which is 590, plus the value of the option that you compute, probability weighted value of the option that you compute in point 3, those two you have to add. It is very, very simple. When you are calm and composed, please think of this, you will be able to understand this. Right. Next, what is net interest position risk and price risk? As I said, this is a slight bouncer. People might not have expected a question like this, but as I said, every single chapter, every single particular theory part is important in SFM. Theory carries 20 marks, and in this question paper, we have seen exactly 20 marks theory. Okay. Now, coming to the next question, mutual funds. This is the mutual funds question what I was mentioning about. Here, you made an investment. We don't know when the investment was made, but annualized yield is available. And based on the annualized yield, because they don't know when the investment was made, you are supposed to find out the holding period of investment. That is when the investment was actually made. Now, we have solved a very, very similar problem. Which is this? This is problem number 11 in our illustrations and problem number 12 as per study material. Now, the other point or rather other extra questions that are asked in this question which we have not solved in the class are two things. Assuming past performance of all these schemes will continue, what action should an investor take? What will be the expected return for 1 year after the above action? So, basically if you look at the question itself, you will understand. There are 3 mutual fund investments. One of them is very, very high. Other 2 are lower than that. One is in fact even negative. So, you should sell out the underperforming investments and put all the money in the outperforming investment. And when you do that, then you will generate this 15% return. Is that what they have asked? Let's see what have they asked. What action should you take? I said sell out underperforming, invest in outperforming. What will be the expected return? After you do this, the expected return will be 15%, right? Because they themselves have said that for the going forward, 15% return will be available for, or the previous year return will be applicable to next year return also, right? That is first part. Now, let us come to the second one. Will your answer above change if a mutual fund charges exit load of 5% if the investment is redeemed within 1 year? If so, advise the investor what and when the action should be taken to optimize return. So, basically what they are saying is, you have this 9.733 you are going to earn if you were to retain in the same scheme. However, if you were to move it, you will earn 15. Now, should you retain it here or should you move it here? We initially said we should move to 15. Same way this negative minus 11.155 also you should move to 15. But they are saying when you are redeeming this 9.733 or minus 11.115, this mutual fund schemes, whatever is the number of units, you will lose 5% as exit load. So, let us say you had 100 rupees. So, 100 into 5%, you will lose 5%. So, basically you are going to get 95. So, whatever 100 rupees is there, you are going to get only 95. That 95 when you are going to reinvest, you are going to earn 15% on that. So, 95 into 1.15 is basically 109.25. So, how much is the return? 9.25%. So, if you were to redeem this scheme A, right? Scheme A, you redeem and put it in scheme C or mutual fund A and put it in mutual fund C, you will earn a 9.25% return. Why? Because there is a 5% exit load. However, if you were to continue in mutual fund A, you will get 9.733. So, which is good? Mutual fund A is good. Don't move it into mutual fund C. But whereas for mutual fund B, what will happen? It is already negative, minus 11. Right. So, minus 11, if you were to redeem, you are going to get 95 into 1.15, which is 109.25, or do you want 89? How did I get 89? 100 minus 11.185%, 89 or 88.815 or something like that. So, which is better? Then also 109.25 is better. So, what you should give answer here is whatever is there in fund B, move to C, whatever is there in fund A, retain in fund A. Okay, so this is a way, it asks 2 extra points, but the points are also very, very simple. Right, now coming to what is the next one, calculate value of share from the following information, and they have given bunch of things. Now, what is this question? Value of share. It is not the value of the firm, either firm by number of shares or you do the total business minus debt and all of that, right? Now, this is a question, this is which question? This question number 2B, right? This question you see is from security evaluation equities, and this question how will you solve? There are 2 points in this question. One is, you're not given interest. Right. So, you have been given PAT, you have not been given interest. So, you have to compute FCFE directly from PAT. However, you have also been given the debt ratio. right? Debt ratio. So how are you going to eliminate the impact of debt in this? So if you remember, I discussed this also. I also told you that in working capital as well as capex minus depreciation, you consider that the capex minus depreciation total amount, a portion of it is funded by debt. So you compute the capex minus depreciation number, net number, you multiply it by 1 minus debt percentage, that is debt in total capital. Same way, working capital increase also, you assume that some amount of working capital increase is going to be funded by debt, which is why they have given this debt ratio. Okay, you are supposed to use this, right? So you are supposed to use this one aspect, and you are supposed to start from profit of the company after tax PAT and arrive at FCFE, and you compute everything per share. It makes your life very, very simple, right? So this is the next one. And finally, coming to the theory part in this, outcomes of financial planning. So this is also a fairly simple one, guys. There was nothing specific in this. It basically says, what are the objectives of financial planning, so on and so forth. You have to discuss about that. What are the objectives, goals, and what are the resources that you have, and all of that. So that we've discussed this in depth even in class as well. Now coming to the next one, which is Skylark system is expanding into operation. This is the GDR one, right? Oh, this is also an easy one, boss. Only complication, if at all there is anything that can arise is they're asking us your computer number of GDRs, and if the company is able to raise at 4% per annum and is able to repay the loan, what is your advice to the company? So basically you have to compute the cost of the GDR. You have to compute the cost of the GDR, and when you do the cost of GDR computation, it is divided by KE minus G is the formula. Only thing here you have to be careful is you have to use net proceeds. That is, the GDR is going to be listed at a discount. That is the first aspect. And then the GDR, whatever you raise, you are only going to get how much? What is the net proceeds? 3%, you are going to get only 97%. So the cost of the GDR should be factored in by considering the net proceeds. It should not be done by using the gross proceeds. If you want to do gross, please do gross also, but then give an assumption and compute net and gross both. I have told this in the class also. This is also fairly simple question. There is nothing complex in this. Right, then comes the next one. This could have been slightly tricky if you had not prepared in, from what I have told. See here, 2017 is given, 18 is given, 19, 20, 21. These are all basically the, data points for over a year. What is the average share price? What is the dividend? What is the average index and all of that? And what are they asking? They are asking us to compute the beta. Right. So what you should do is, if you remember, we've discussed this multiple times. Beta, volatility, everything, correlation, everything is computed on returns. Now returns are not given directly, they have given the average price for a year. So you have to basically take 2017 to 2018, what is the movement. So it has moved from 460 to 497. So you have to take 497 minus 460 divided by 460, that is going to be your return for 1 year. To that you also have to add the dividend, which is this 33. That will give you basically the return for this company Swecha Limited. So please note the first two columns are for Swecha, next two columns are for market, and the last column is for government bond. And government bond is consistently 5.5, so risk-free rate is 5.5. Right. So you have to compute the same way for what you do for Swecha Limited. You have to compute the returns. For market, you have to compute the returns. Once you have both the returns, you can very easily compute what is beta. And what is the second part of the question? What is your observation? What is observation? What do you mean by observation? Observation here refers to whether you are supposed to buy or sell a share at which point of time. How will you buy or sell a share? You will compute the actual return, whatever is given, and using the beta, you will compute the CAPM return. Now, if CAPM return is more than the actual return, then you will say sell. If CAPM return is less than the actual return, then you will say buy. It is very, very simple. There is nothing complex. How will you compute CAPM return? You have got the beta, you have got the risk-free rate, you have got the return of the market. That's it. Very, very simple. Okay. Now, what are FCCBs? Boss, FCCB ke liye, I have given lot of information. What is an FCCB? You basically discounted, you bring them, there is a conversion rate. The conversion is at a future date. There are advantages. You can postpone your dilution. When the price goes up, then you'll be able to allot it at a higher rate. We have discussed a lot of things about this. Okay. So I hope, whoever has attended my class, I am pretty sure will be able to answer this particular question very easily. Now coming to question 4a. What is question 4a? Available pertaining to ABC, which is expected to grow at a height of 3 years, after which growth rate will stabilize. So this is again a question on, this is a corporate valuation question. So this is a question on corporate valuation, and for this particular question, you are supposed to create a projected, P&L or projected cash flows. From the projected cash flows, you are supposed to compute the FCFF or FCFE. What have they given here? They are given, all the data with respect to EBIT, capex, depreciation. What is the specific question? The specific question is You are requested to find out the value of ABC. Value of ABC means value of the entity, not the value of the shareholders or not the value of the share. So, you have to compute the overall value of the entity or business, which means FCFF, not FCFE. Okay, that is the only thing. Other than that, this is very, very simple, and we have solved this particular question in the class. What is it? What is this question number? Corporate valuation. This is question number 11 in our notes and question number 7 from study material. See guys, this entire syllabus, no, they have covered it straight, entire question paper, they have covered it straight from study material, as I have been saying. Okay, now next one, mutual fund. See, you see there are two problems on mutual funds this time. Very interesting. Mutual fund made an issue of offer of 10 lakh units of 10 each. Okay, so 10 lakhs into 10 is 1 crore. No entry load was charged. It made the investment. So, it made investments of how much? 80, 4, 5 and 10. So, basically 99 lakhs was invested. So, 1 lakh is not invested. So, that 1 lakh is lying as cash. Okay, I think that is the only trick in this particular question. There is nothing else in this question. Right. So, then during the year some money came in, then some dividends, some then interest were received and so on and so forth. Then there was an interim dividend of 10% was, they declared the interim dividend of 10%, bonus shares of 1:10 with record date of 28 December. Now, mutual fund made an offer. So, when there is an interim dividend, then you will actually get inflow. So, you have to take that also into consideration. Now, bonus, how does it matter what the bonus is? Does the bonus in any way change the value of the shares? Right? Have they given what is the value of the share? Equity shares were appreciated by 15%. So, overall value of investment could have appreciated. It doesn't matter. Right? So, it really doesn't matter how this particular bonus shares are allotted, because the value of the investment is not going to change. But what will change is dividends received is 8 lakhs and 10% dividend was declared, but it was not received. Okay, the record date was 28 December. They never said whether it was received or not received. Right. So, this 10% dividend into 80 lakhs. So, 25,000 equity shares of 100 each basically means 25 lakh shares. 25 lakh shares, that is the face value. 25 lakhs into 10% is 2.5 lakhs. So, you have to actually consider additional 2.5 lakhs as dividend that is receivable. That is receivable, not yet received, right? 8 years is 8 lakhs is already received, but this 2.5 lakhs is not received. Bonus has really no implication. Okay, so this is the thing, everything else is very, very simple in this particular round, there is nothing else. Then coming to benefits of securitization, boss, we have discussed this benefit to the person who is doing the securitization, who is the originator, person who is getting the securitization done. We discussed all the benefits also in the class, right? It was very, very simple chapter. Securitization, please believe me, you spend 40-45 minutes in revising, you will get 4 marks very clearly for sure shot in the exam. Every attempt we have seen, and we have discussed this also multiple times. Okay, coming to the next one, question number 5. This is an M&A question, and this M&A question also we have solved it. Where M&A question we have solved it. Question number 18 in our illustrations and 14 as for study material. This is also straight direct taken from study material. Is there any complication in this? No, there is absolutely no complication in this question. This you have to arrive at the, what is the post-merger value, how much of share is held by each one of them, and then, what is the post-merger value is to be computed using the PE of the acquirer company, and acquirer company, what is the ratio of exchange ratio in exchange of 5 new shares of Vasavi for 8 shares held in the target. So, it is very, very simple. There is nothing complex in this question. It is a simple full task question if you ask me. Right, next one, this could have been, this is 5B, this could have been slightly tricky if you have not prepared on the security analysis chapter. This is security analysis only, no? Yes, this is security analysis chapter. So, this is question number 1 actually of this chapter, right. So, in this chapter, you are supposed to compute the exponential moving average. What is exponential moving average? We actually have a formula for that also. What is exponential moving average? Basically, you compute the value of an exponent called A. What is value of A? A is equal to 2 by n plus 1. What is n? N is the number of days. Here, 15 days is the value of the exponent, right? 15 days EMA. So, 2 by 15 plus 1, that is 2 by 16, which is 1 by 8, which is 0.125. So, exponent value has to be considered as 0.125, and then what you do is, for the first period, the price is taken as the average for the previous month, which is December 21, which is 17,174 is taken as the price of the opening. To that, you multiply the 1 minus exponent value, then you add plus 17,626, which is the first date, and you multiply it with the exponent value of 0.125. You take the average of these two, and then you arrive at the EMA. The EMA becomes the, the number that is used for the next day's computation of EMA. So, basically 17,805 into 0.125 plus 1 minus 0.125 into whatever is the EMA, you arrive at the for the first day. Like that, you go on computing and then you see what are the EMAs and then you see the trend of the EMA. If the EMA is upward trending, it is bullish. If it is downward trending, it is bearish. That's all. I think that is what they have asked. Compute the value of the exponent. I told you 2 by n plus 1. Exponential moving average during the above period. I told you how to compute. Then analyze the buy and sell signal. It is very clear. Buy and sell signal. If it is upward trending, buy. Otherwise, sell. Right. So this question. No, if you go back, actually, this I believe was asked in May 18. New syllabus. After that, it has not been asked, but I think these are the kind of questions that should be careful. You should remember these formulae. 2 by n plus 1, that is one single number, and a into exponent into the price plus EMA into 1 minus exponent that is also something that you should remember. Right? So that is done. Then explain compliance risk and operational risk. This is risk management, the risk of non-complying, risk of operation, something going wrong. This also we discussed. This also we discussed in the class. It is very, very simple. This is a 4-mark question. Now come to question number 6. Covariance and correlation. This is a correlation, covariance, standard deviation, mean. I overdid it. If you ask me, I taught to you guys so many times in the class. Right from chapter 2. From risk management chapter onwards, I have been drilling mean, standard deviation, correlation, covariance, and we have discussed so many formulae for this. What is covariance formula? Sigma x minus x bar into y minus y bar by n. And what is, this is covariance formula. Correlation is covariance by standard deviation x, standard deviation y. You take simple formula and work it out, you will automatically get the answer. Right. There are multiple formulas to compute also, but you take one formula, which is the simplest what I have explained to you. Sigma x minus x bar into y minus y bar by n, you will automatically get the answer. Right. Then coming to the last one, MPD issues a 50 million floating rate loan, so and so. This there's a 3-year cap and a 3-year floor. Right, and this is a no cost collar because cap price premium paid is equal to value of the premium received for the floor. So this is all, and there are interest reset dates, and you see if the loan was taken on 1st July, so the first interest payment is due on 31st of December. It's a 6-month thing, right? 6 months, and this cap and floor are specifically for LIBOR, not for the spread. Then what else? The first interest is due on 31st December. For which the prices are LIBOR is already set on July 1st. It is not, whatever is the LIBOR applicable on 31/12 is applicable for the next period. We discussed this also. I explained to you saying that when you take a loan, the rate that is applicable on the day of borrowing is the rate that will be applicable for you to pay the first interest payment. Okay, please think of your housing loan or any loan. Okay, and this 7 is between 5 and 8. So obviously for the first interest due date or first the interest payment date, there is no implication. After that, 8% cap. So this 8 and 8 again, no problem. Then 5% floor, that also there is no issue. If at all there is an issue, it is only in these two cases, which is period 30th June 20 and 31st December 20, where it is below the floor. It has never crossed the cap. So actually there is no issue at all. Right. So this is very, very clear. You have to compute the interest paid in each of the quarter, overall effective interest rate, which is basically the total interest divided by the loan that is taken, and you multiply it by the number of periods divided by 365. Or here, what have they said? Have they said anything about the convention, day convention? They have not said. So you can divide it by the number of years and you will automatically get the annualized rate. Okay. This is done. Then define angel investor. So define angel investors. Are these individuals? Yes, these are typically are individuals, but also you have angel investment VCs. You have people who do angel investment collectives. Bunch of that. We discussed this. I explained this to you in depth. Then criteria for to be classified as a startup boss. This is straight. The number of years you have to make an application, how many, it has to be in a specific area, you have to start operations and so after so and so period and all that. We have discussed this also. So friends, this is a very, very simple paper. So if you come back to the analysis, right, all the questions are from study material except one which is from practice manual, and I have given in this sheet, okay, page numbers also. Page numbers of the source and study material as well as my Indigolearn material, everything I have given the source. Okay, if you had gone through our videos fully, thoroughly, believe me, this paper would have been a cakewalk. Just to come back and just finally conclude on one specific aspect. So if you look at this, right, May 22, they have covered all the chapters. No chapter has been left. Portfolio management, they have asked 16 marks question. Then where else have they asked extra questions? International financial management, they have asked 12 marks. Interest rate management, they have asked 12 marks. All other chapters, and yeah, mutual fund, they have asked 2 questions, 16 marks. Otherwise, all chapters are covered and they are very much in line. So this 32 versus 20 to 30 marks is 28 versus 20 to 25 marks, 32 versus 20 to 30 marks, 8 for 5 to 10 marks, then here 4 for 5 to 10 marks, then 16 for 10 to 15 marks. Every single place they have been in line with the ICA weightage what the institute has already given. Okay, so if you have, this particular, I am also going to upload what are the kind of questions, how does these questions compare with the previous papers and all of that. You already must have seen this particular sheet, right, available in free resources. If you have not seen, please go visit our free resources and have a look. Okay, very, very simple. We have covered all the new syllabus question papers, given a summary of the kind of questions that have been asked. One shot, you will understand what is going on. Right. So, if you have, done this paper well, very good. If you have not done this paper well, even then very good, because I think you should concentrate on the next paper. Right. So, my suggestion, you should concentrate on the next paper and you should forget what happened. If you want, you can come back and revisit whatever I have discussed post your exams. After the last day of your exam, you can come and revisit. Otherwise, don't spend any time on this. Okay. So, fair enough. That's the thing, friends. So, my suggestion, just go ahead with your subsequent exams and do very well. All the best.